The webinar will begin in 2 minutes. The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar entitled Timely Tax Reminders for Our Clients, Form 1099-R Issues. The webinar will last approximately 15 to 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He also ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. His latest book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, which was written together with a CPA and a business broker, is now available for sale. Linus will draw on his legal, tax, life insurance background, and his practical experience for today's webinar. And here he is.
Thank you, Jennifer, and hello, everyone, and thank you for joining us today. Before we get started, let me say that Jennifer and I sincerely hope that each of you on the call, as well as your loved ones, are avoiding the effects of the coronavirus. It's certainly changed the way that we are all living, changing the way that we are all doing business, and it's certainly an interesting time related to all that. So in any event, it is our hope and our prayer that that you avoid the worst effects of the coronavirus in yourselves and in your loved ones. Let's go on with what it is that we're going to talk about today. But before we do, let's decide what we're going to talk about next month. Well, there's nothing really to decide. Jennifer and I have been getting a lot of calls about the CARES Act. A lot of things that are addressed in the Act and a lot of the things that are not addressed in the Act, and we'll talk about that next month. I would invite you, if you're planning to attend next month, that you pass along questions that you have about the Act to us, and we'll include those things that that you ask about in the webinar next month. We'll also do our best to respond to you directly to your question, but if we know what's on your mind, it certainly helps us to come up with relevant content for you. So we'll talk about the CARES Act next month. This month, we're going to talk about some things that are timely. We're going to talk primarily about Form 1099-R, unexpected Form 1099-R that your clients may get. It is the time of year when taxpayers are thinking about their tax returns. Although the tax deadline has been extended to July 15th, our clients have gotten Form 1099-R, and between now and July 15th, they're probably going to be looking at them and asking questions about the information on Form 1099-R. And one of the things that I think Jennifer and I hear about a lot is that a taxpayer gets a 1099-R that the taxpayer doesn't expect, and the life insurance professional or financial professional doesn't quite know how to address the question that the client is asking related to Form 1099-R. So we're going to give a few examples of Form 1099-R that the client receives that the client doesn't expect, and how to equip you, if you haven't already kind of learned how to deal with that question, how to equip you to answer the client's question about the most common 1099-R questions that we get asked. The first one has to do with 60-day rollovers of qualified funds. The law allows for a client to take money out of an IRA or another qualified account, put the money in their checking account, for example, but within 60 days of receiving the money, redeposit that money into another qualified account, such as an IRA. And if the client does that properly, the transaction is income tax free. That's the good news. The bad news is that when a client does that, the client is going to get Form 1099-R from the institution that sent the client the qualified funds. Now here's an example. This is a common example. So let's use an IRA to make things simple. And let's talk about in 2019, Fred took a complete distribution from an IRA, 75 grand. He put it in his checking account, but within 60 days of receiving the money, he wrote a check for 75 grand into a new IRA, and that completes the valid 60-day rollover. And before you ask, and before some of the more technical of you ask, let's say that Fred had done no other 60-day rollover from IRA to IRA in the prior year. And so Fred does a valid 60-day rollover, but then Fred gets a 1099-R from the old IRA custodian showing a gross distribution of 75 grand. And it shows that the 75 grand was taxable, and the carrier put a distribution code of 7 in box 7 of 1, early distribution, no known exception. Let's say that Fred is younger than age 59 and a half, and Fred is upset. Fred, calls up his financial professional and asks that 1099-R be corrected, because Fred says it shows a taxable amount. Fred doesn't want to claim that on his 1040 as a taxable amount and wants the 1099-R fixed. And the first thing to know is that from the IRS's perspective, the payer reported the transaction on Form 1099 properly. So let's take a look at what the Form 1099 looks like. If you get asked about something like this, we encourage you to ask for a copy of Form 1099-R so that you know what it says. So here's a generic Form 1099-R. It's got a lot of information on there, but from our perspective, the key fields are the ones that we're going to point out. Let's say, this one is addressed to Fred at Fred's address. In this case, the gross distribution, in this example, the gross distribution would be listed as $75,000. And the taxable amount would also be listed as $75,000 because the custodian of the IRA sent that amount to Fred. Whole distribution was taxable from the custodian's perspective. And in field number 7, the custodian would put in distribution code number 1 because Fred is younger than 59 and a half. And those are the key fields for you to look at when your client is asking you about Form 1099-R that perhaps the client received and the client didn't expect. So what does this distribution code mean? Well, if you look at the instructions for Form 1099-R, you can see that in the instructions for box 7 tells the custodian what code to put in box 7. And so in this case, because Fred was younger than age 59 and a half, the custodian put in number 1. It's an early distribution with no known exception. If Fred was older than age 59 and a half, the custodian would have chosen to put in code number 7, a normal distribution. Well, Fred is going to ask, well, why doesn't the custodian, the old custodian, put in a code that verifies that this is a 60-day rollover? Well, if you look through all the code possibilities on that page, you see that there's nothing in there for an indirect rollover, a 60-day rollover. And so let's go to the next page of the instructions and see what other choices we've got for codes that will go in box 7. And there's nothing there either for 60-day rollovers. The closest one, I guess, would be code G, which would be a direct rollover of a distribution to a qualified plan. That's where the money is sent directly without it going into the client's checking account. And that's not what this is, right? This is a 60-day rollover. So G doesn't apply. And it makes some sense that the old carrier, the old custodian, wouldn't code this as an indirect rollover because it has no idea that the client is going to complete a valid 60-day rollover. In fact, it's not responsible for investigating that. So the old carrier makes perfect sense, would simply code the distribution as number 1 or number 7. So how does the client tell the IRS that there was a valid 60-day rollover and that the amount is not taxable? Well, it's up to the taxpayer to do that on their individual income tax return. Now, the IRS has some resources that kind of help explain that for the taxpayer, but we're going to go through it a little bit. The service says that you put the total amount in the relevant field, you write the word rollover in the margin next to the taxable amount line. What does that mean on the current 1040? Well, you put all that stuff on line 4, and here's how it ends up looking on Fred's individual income tax return, or anyone's for that matter. If you look down to line 4A, in this example, it was an IRA distribution that we were dealing with. In line 4A, we are going to put down the amount of the gross distribution. In the example, 75 grand. And then right to the left of 4B, Fred or Fred's tax preparer is going to write in the word rollover. And then on line 4B, the net amount of the distribution, the taxable amount of the distribution, that's going to go there. So in this case, that would be 0. The gross distribution would be 75. The word rollover would appear where the word rollover appears, and the net distribution would be 0. And that's how the Form 1099-R and the actual taxable amount are reconciled by the taxpayer on the tax return. Now, if the taxpayer hears about this for the first time after the fact, the taxpayer is going to be a little unhappy because it feels like more work. But if you tell the taxpayer up front when the taxpayer is planning to do a 60-day rollover, assuming that you are involved in the process, it makes things a little bit easier because this won't be the first time that they've heard that they have to go through this process to make sure that the rollover is reported as a non-taxable event. So that's how it works. It is a little bit of work, but that's how it works. Now, there's something similar that happens with regard to qualified charitable distributions. Qualified charitable distributions have been around for a long time now. It is available from an IRA platform when the account owner is 70 and a half or older. By the way, the account owner does not have to be 72 to do QCDs, still only 70 and a half. And QCDs are not tied to the RMD obligation, even though, and we'll talk about this more next month, RMDs have been waived for 2020. Taxpayers still perfectly capable of doing a QCD for 2020 if they are otherwise eligible, meaning that they've got IRA money and they are at least 70 and a half. They can do up to 100 grand. And the narrative in support of a taxpayer doing this is that QCDs are tax-free. No one has to itemize it. It's just a tax-free distribution. However, and this is likely to be a surprise to the client, QCDs are reported as distributions by the custodian, and they are reported as taxable, which seems to make no sense. You would think that the IRS would put a code on Form 1099-R for QCDs, but there is no such code. And so QCDs are reported as normal taxable distributions on the 1099-R. Well, how does the client reconcile that on the client's income tax return? Well, the IRS gives instructions for that, and the instructions are very similar to the instructions for 60-day rollovers. And so again, we're looking at line 4A in this example. On line 4A, in line 4A, the gross distribution is listed. The taxpayer puts the letters QCD just to the left of line 4B, and then the net taxable distribution is listed in line 4B. So the QCD amount is subtracted out of the gross distributions taken from the IRA, and that's how the taxpayer reconciles the information on Form 1099-R with what's actually reported on the income tax return. So one more example of taxpayers wondering, what's going on with 1099 reporting is in the context of Section 1035 exchanges. Those of us in the life insurance business know that we can trade one life policy for another, or one annuity for another, income tax free if we follow the Section 1035 rules. So in this example, we've got Wilma, who had an in-force permanent life policy with her cost basis of 100 grand, cash value of 25 grand. She performs a 1035 exchange for an annuity. So it's a life for annuity, which is a valid 1035 exchange. And both the old and new companies treat the transaction as a 1035 exchange. The money goes directly. However, Wilma gets Form 1099-R from the old carrier, and she's upset because she was told the transaction was going to be income tax free. And the form does kind of indicate that it's going to be tax free, but it can be confusing. If we take a look at an example of Form 1099 for this transaction, you can see why Wilma might get confused, because it shows a gross distribution of 125 grand. That's the 1035 exchange amount, but it shows a taxable amount of 25 grand. And Wilma's like, well, I thought this was tax-free. Why does it show a taxable amount? And the key is that in the distribution code, we get code number 6, which is the code for a 1035 exchange. Remember, in the earlier example of Fred, we got distribution code 1 because it was pre-59.5 distribution. We could have gotten distribution code 7, which was a normal distribution. Distribution code 6 is the distribution code for a 1035 exchange. So Wilma's 1099-R is correct. The fact that it's distribution code 6 that makes it a tax-free 1035 exchange. While we were talking about 1035 exchange, let me point one other thing out. This question comes up a lot still, even though, and I've been answering this one for more than 30 years. The idea of taxable boot can come up in connection with a 1035 exchange. It most often comes up where the policy owner has a loan against the old contract, the old life contract, and tries to trade it for a new life or annuity contract without a loan. The IRS has said, well, when the loan disappears as part of a 1035 exchange, the loan forgiveness is a taxable distribution and it comes out of the gain portion first. And that's counterintuitive for somebody who's never run into it before, but it's the way things work. And so here's a quick example. Let's say we've got Barney, life insurance policy, $150,000 basis, 45 of net surrender value, and 130 grand of outstanding loan. Barney does a 1035 exchange, the loan disappears. The old carrier issues 2 forms 1099-R. The first one shows a distribution of 130 grand, which is the loan forgiveness, and all of the gain, 25 grand, is shown as a taxable amount, and that is eaten up first. And so there's a taxable event on one form 1099-R, the other shows the 1035 exchange as code 6 in box 7 of the form. So while it is a valid 1035 exchange, in this example, Barney has to pay income tax on all the gain in the policy because the loan that disappeared in connection with the 1035 exchange was bigger than the gain in the contract. So in any event, when our clients get 1099-Rs, a lot of times they are unexpected, but they very well may be correct and they need to be coached, probably in connection with their own tax preparer, about how to reconcile the information on their income tax return. As an aside, on 1035 exchanges, it is possible to do an exchange for one loaned up policy for a new policy that has a loan of at least the same amount. The IRS says that when you do that properly, that does not create taxable boot and is a valid tax-free 1035 exchange. So some carriers still do that, but some people try to use partial withdrawals taken on Monday to pay off the loan on an existing policy, and then do the exchange on Friday. The IRS a lot of times will mash those steps together and find taxable boot even where somebody tries to do things in the right order. And so there are a lot of potential pitfalls there. If you've got a situation like that, feel welcome to give us a holler so that we can help you sort through the issues. So what are the takeaways from today? First of all, tax season can be a high stress season. It's already high stress this year, but tax season can create extra stress. Those of us who are life insurance and financial professionals routinely help out our clients with 60-day rollovers, QCDs, and Section 1035 exchanges. It's a best practice for us to coach our clients about what to expect from Forms 1099-R and how to deal with the information on those forms. But we'll probably also want to touch base with our clients this time of year as they're thinking about their income tax returns between now and July to help make sure that they know how to deal with the 1099-Rs that they've gotten from transactions that took place last year. It's really an opportunity to provide excellent service to our clients. And at this point, what I'd like to do is I'd like to thank you again for joining us, invite you to join us next month as we talk about the CARES Act, and I will turn the program back over to Jennifer.
Thanks, Linus, and thanks for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.